Hello and welcome to Investment Insight, your clear take on the markets. Let's get started. So today we're doing a bit of a deep dive. We've got sources showing, well, some really big cracks in how people think about investing safety. We're unpacking two major shifts, structural shifts, that are really changing how investors see safety and risk. Like right now, it feels like it's time to fundamentally question what we thought we knew about safe havens.
That's exactly the mission. And our sources, they're suggesting these aren't just minor market wiggles. These look like fundamental changes, changes that mean you might need to rethink your portfolio. So we're splitting this into two main themes today. First up, we'll dig into the U.S. Treasury market. It's always been seen as the king of safety, right? But now, well, it's showing signs of serious weakness in demand, structurally. And second, we're going to look at how the U.S.-China tech tussle is really expanding. It's not just about fancy chips or phones anymore. No, it's hitting everyday gear, like the Wi-Fi router maybe sitting in your office right now. And crucially, it's targeting the information itself, the analysis.
Right. And our goal is pretty simple, really. We want to give you a clear, kind of actionable understanding of these shifts. Focus on those aha moments. Because if the very definition of safe is changing, well, you need to know how to react, don't you?
Yeah.
Okay, let's get into it. And I guess we have to start with what's supposed to be the safest asset on the planet. Let's look at the Treasury market. The cold, hard data. The core issue seems to stem from these recent auctions, the 10-year and 30-year bonds. They were, well, disappointing seems to be the word, pointing to weak demand and maybe something more structural than just, current rate worries.
Yeah, disappointing is a key word here. Let's put some context on that. Take the 10-year auction, that was October 8th. The bid-to-cover ratio. Think of it like this. For every bond the government wants to sell, how many bids did they actually get? It came in at 2.48. Now, that number itself might not mean much, but it's below the recent average, which was about 2.59. Not, a complete disaster, but definitely a sign that interest is cooling.
In the 30-year auction, that sounded even more worrying.
It did. Multiple sources called it tepid. But here's the real kicker, I think. It's the primary dealers. These are the big banks, the major players, who are actually obligated to show up and bid at these auctions. They have to participate. And their participation, it hit a historically low level in that 30-year auction. So when the pros, the specialists who live and breathe this stuff, are basically saying, maybe not at this price, well, that's a pretty loud alarm bell about future demand.
Okay, and that feeds right into this idea that the old flight to safety isn't working anymore. This is where it gets really interesting, right? The old rules seem broken.
Totally broken. For decades. I mean, the playbook was simple. Stocks go down, trouble brews somewhere in the world, political mess in D.C., money just automatically flowed into U.S. Treasuries. It was the ultimate safe harbor, no questions asked.
But now we see the opposite. Stock market's jumpy, politics are uncertain, maybe a shutdown looms, and long-term treasuries are getting sold. How does that even happen?
Well, what our sources are suggesting is that the market is now looking at the U.S. government's own issues. The shutdown risks, the ballooning deficits, the debt trajectory, all that political dysfunction. And investors are concluding that this risk, the government's own fiscal and political risk, might actually be more dangerous than just regular stock market bumps. It's like the anchor that was supposed to hold the ship steady is now potentially dragging it down. That's a massive shift in perception.
Wow. So if the long-term debt from the world's safest borrower is being ditched, where's the money going? Is it just fleeing bonds altogether?
Not entirely, no. It's not like a total exit from bonds. It's more like moving to a safer house on the same block, if that makes sense. It's moving up the quality ladder and, crucially, shortening the time commitment, the duration. We're seeing clear outflows from long-term treasury funds. That big ETF, TLT, its assets have dipped below $50 billion. Money's leaving.
Okay, so where are these safer houses, these new safe neighbors?
They're looking for borrowers who seem, frankly, more structurally sound than the government itself right now. So the money's flowing heavily into two main areas. First, top-tier investment-grade corporate bonds. Think bonds issued by companies with fortress balance sheets, massive cash flow, like Microsoft or similar giants. The market seems to feel more confident about, say, Microsoft paying them back over 10 years than about Congress getting its fiscal house in order. It's quite a statement. And the second big area is municipal bonds, munis. Debt from state and local governments. For U.S. investors especially, these offer stability plus often tax advantages. So compared to taxed corporates, where these newly risky long-term treasuries, they look pretty attractive.
This really throws a wrench in the works for the classic 60-40 portfolio, doesn't it? 60% stocks, 40% bonds for safety. If that bond 40% is just stuffed with long-term treasuries, you're actually holding quite a bit of risk now. But hang on, are we asking the average person to suddenly become a bond expert? Differentiating T-bills, AAA corporates, munis? That sounds complicated. Can't you just tick everything safe in short-term T-bills?
It's a fair point. It definitely adds complexity, but the market is kind of forcing our hand here. The reason you can't just use T-bills is, hey, well, they do protect your initial money, your principal, sure, but they don't really diversify you against different kinds of risk. You need different tools for different potential problems. Think of it like building layers of defense. We need to sort of visualize a new hierarchy of safety, like different levels of protection. Tier 1. Top safety. This is purely about keeping your money safe and accessible, like right now. So cash, money markets, and ultra-short T-bills. If you need it next week, it's here. No risk to principal. Tier 2, hedging government risk. Okay, this layer is specifically designed to protect against that domestic political and fiscal mess we talked about. This is where you put gold, the classic hedge against political uncertainty, and those super safe AAA-rated corporate bonds. The idea is if the government wobbles, these might hold up better. Tier 3, alternative safety and income. This is about stable income, often with tax benefits. So primarily municipal bonds, especially for U.S. investors. They offer stability away from federal drama. The big message is safety isn't just one thing anymore. It's a system you build, layer by layer.
And underpinning all this is duration risk. Let's make that super simple. It's like lock your money in a 30-year CD, right? You buy that bond today, it looks okay. But if interest rates shoot up next year, suddenly your bond paying the old lower rate isn't worth as much. You're stuck.
Exactly. And those weak auction results, that's the market screaming, we see that risk. We want to be paid a higher interest rate to lock our money up for 30 years. So the actionable strategy really coming out of this first theme is you probably want to shorten the average duration, the average time lock of your bond holdings, at least until things settle down.
And you mentioned opportunity, too, with money moving into corporate bonds. That's about credit spreads. Quick refresh on that.
Yeah, absolutely. The credit spread is basically the extra yield, the bonus interest you get for taking on the slightly higher risk of lending to a company instead of the risk-free government. So if a 10-year Treasury pays 5% and a similar Microsoft bond pays 5.5%, that extra 0.5%, that's the credit spread. Now, if lots of money rushes into high-quality corporate bonds because Treasuries look shaky, the price of those corporate bonds goes up, their yield goes down slightly relative to Treasuries. The spread shrinks. And that means those corporate bonds can actually outperform Treasuries even if overall interest rates are going sideways or even up a bit. It's about relative value.
Got it. Okay, fascinating stuff. So we've tackled this huge internal financial risk, the stability of U.S. debt itself. That's a major shock. Now let's pivot. Let's talk about external operational risk, because the U.S.-China tech battle, it's widening, isn't it? Risk is creeping into the digital plumbing of our lives. Okay, let's talk routers. Seriously, routers.
It's a really important transition, actually, because both themes boil down to trust, don't they? Theme 1 was about trusting the government's finances. Theme 2 is about trusting the gear that carries your data. And yeah, the tech Cold War is now zeroing in on incredibly common stuff, like TP-Link.
TP-Link, they're massive, aren't they? Don't they make routers for, like, everyone?
They're the world's biggest maker of Wi-Fi routers, yeah. And our sources are confirming the U.S. Commerce Department is getting close, real close, to labeling them a national security threat. This comes after, apparently, a year-long investigation into their ties with the Chinese government.
Wow. Okay, what's TP-Link saying? They must be pushing back.
Oh, hard. They're arguing, hey, we're a U.S. corporation now. They say they've moved R&D, they've legally separated their U.S. and Chinese businesses, basically trying to build a firewall. They argue that this corporate split should be enough, but
the hardliners in Congress aren't buying it.
Not really, no. Their argument is that just changing the corporate structure doesn't magically remove the risk of potential backdoors or data being accessed or influence being exerted by Beijing. And the insight here is pretty stark. The definition of risky tech hardware has just blown wide open. It's not just about super advanced chips anymore. It's the everyday routers, the network switches. The basic infrastructure of our digital lives is now potentially on the front line.
Okay, now here's where the plot thickens, right?
Yeah.
China's countermove. They aren't just hitting back on hardware. They're targeting information, the analysis itself.
Exactly. That's the really strategic shift we're seeing in the sources. Look at the blacklisting of Tech Insights. They're a Canadian firm. They analyze semiconductors. Now, China's official reason was something about military tech cooperation with Taiwan. That was the line.
But that wasn't the real reason, was it? What was really going on?
Almost certainly not. The real issue. Tech Insights was the company that did that super detailed teardown of Huawei's latest advanced AI chip. And when they took it apart, they published their findings. And those findings showed the chip relied really heavily on stockpiled memory HBM from foreign companies like Samsung and SK Hynix in South Korea.
Ah, so they basically expose a weakness like your fancy chip depends on stuff you can't make yet.
Precisely. They analyzed that Huawei likely had a limited stockpile of this critical memory, and it would win out. It exposed a bottleneck in China's whole push for tech self-sufficiency. So, by blacklisting Tech Insights, Beijing sends a chilling message. We're not just coming after tech, we're coming after anyone who analyzes our tech and points out our weaknesses. It's an information war.
This changes everything for investors doing their homework, doesn't it?
Yeah.
Your risk check now has to go way beyond just like supply chains for parts. You got to look at a company's reliance on all its network gear, routers, switches, everything, and also whether it's involved in data or analysis that might touch this conflict zone.
Absolutely. And that TP-Link situation, it sets a huge precedent for companies caught in the middle. Just splitting the company, like TikTok has talked about or others might try, that clearly isn't going to be enough anymore to satisfy U.S. security worries. Companies are going to have to demonstrate much, much higher levels of transparency about their governance, about where data lives, about who truly controls things. And this need for transparency, this sort of verified trustworthiness, it almost becomes a new factor in how you value a company. Call it a transparency premium. Investors will pay more for companies they can actually trust.
Okay, but where there's disruption, there's usually opportunity somewhere else. If companies start ditching TP-Link, who benefits? Who fills that gap?
Yeah, it definitely creates openings. If there's a big DTP Link move, well, that obviously benefits trusted network equipment makers, probably U.S. firms or allies. Think Cisco, maybe Netgear, companies like that. And similarly, blacklisting a major analyst firm like Tech Insights, that creates a huge gap in the market for competing analysis, for consulting services that can maintain trust with Western clients needing that info. So just to wrap up our deep dive here, we've really looked at two massive kind of tectonic shifts. First, that foundation of U.S. Treasury safety. It's got cracks, and that forces a rethink of portfolios pushing safety towards short-term cash, gold, high-quality corporates. Second, the tech war is broadening. It's now about everyday gear like routers, and critically, about controlling the information flow, the analysis of technology itself. Both these shifts mean you absolutely have to update your mental definitions of what's safe and what's risky as we head further into 2025.
So, thinking about the big picture, what does this all really mean? For years, the bedrock assumption was government stability. Government bonds were the ultimate safe haven against any storm. But now, the market itself is questioning the fiscal, the political stability of the U.S. government. So the question you really have to wrestle with is this. If things like cash and gold are now becoming the main hedges against domestic political risk, what asset out there is truly left hedging against global, systemic black swan type risk? Something for you to think about. Don't forget to subscribe and hit that like button.